Good morning. Welcome to Trading Hour. It's a quiet Tuesday morning so far. I'm Reema Tendulkar. With me is Surbhi Upadhyay. Hi, Surbhi. Yesterday was like the big swing day, right? Markets were down about, 250 points, finally managed to close up in the green. But today things are quiet. The global markets were also largely directionless, sideways. And even in the Indian markets, we're holding up in the green, and I think that's a good thing. So inching towards 22,150 now on the Nifty.
No, absolutely, Reema. I think directionally, there's no clarity on what exactly this market's doing. It's very choppy. It's in a range. And the bulls are hoping, best case scenario, that the downside is going to be protected around the recent lows that we've made. For today, for what it's worth, seeing some interesting traction on a couple of auto stocks. If you talk about the Nifty best performers, and M&M is coming up right in style now. There's almost a 4% up move underway on Mahindra & Mahindra. And Hero is a close second. Hero is up about 2.5%. So that's one part of it. That select auto stocks, and I'm saying select because it's not like there's a wide sector-wide move. There's also Eicher. Eicher's put on about 0.5%. So autos are getting a bit of a thumbs up. That's one story. And the other are the commodity-related plays, particularly metals and material stocks. So the likes of Hindalco, JSW Steel, Coal India, there is some buying that's going on over here. That's on the upside. However, a lot of consumer stocks are pushing lower today, and that's a very clear marked trend. So you've got a Britannia down 1.5%, Nestle is losing 1%, Asian Paints is on the lower side, Tata Consumer is on the lower side. So, Reema, I guess this consumer spark that we had at the beginning of last week, that's really not sustained. It's kind of fizzled out, one would have to say. Today, our Colgate numbers, I mean, we'll see if that company's commentary is going to be strong or not. But otherwise, consumers are a bit of a spoiled sport or a weak spot in trade today.
Well, indeed, the Nifty FMCG index is down close to just about 0.3%. But as you pointed out, Britannia, Nestle, ITC, all of them are under pressure. A couple of the other notable gainers include that in the metal space. So Hindalco, JSW Steel. On Hindalco, of course, there's news, and that's pushing the stock up close to about 2%. But that's a pocket where you are seeing continuous strength. So metals are higher in trade. Adani Group stocks were up yesterday, and they're carrying forward the momentum. But I think, as you pointed out, it's largely been about the auto and individual stocks like HAL, where UBS has raised the target price all the way to 5,300. So HAL is a big mover. BEML is a stock. Yeah, BEML.
After 15% yesterday, there's another 5% on BEML this morning. So absolutely stunning.
Or Cochin Shipyard, for instance, that's been another big mover. And then there is a lot of interest surrounding Zomato as well. The stock today is down close to about 2%, despite brokerages raising the target price. But then, of course, the stock is up 200% in the last 1 year, but taking a bit of a pause, Zomato right now.
Absolutely. So lots of individual movers and shakers, but we don't have a major sort of index level headline for you. That kind of sums up this Tuesday morning. Well, let's stick to then individual, newsmakers and stocks that are in focus, starting with some of the big boys in the Nifty. And Shriram Finance is right up there on that list. Now, of course, the news is very well known. The stock has been reacting to the fact that Shriram is selling its housing finance business completely. We have Abhishek joining in. We also caught up with the management just a while back. So Abhishek, fill us in on the management takeaways and the market's interpretation of this move.
Well, Shriram Finance is looking to sell stake in Shriram Housing Finance. The transaction is worth rupees 4,630 crores. Now, they will sell this to Mango Crest Investment, which is an affiliate of Warburg Pincus, and they will purchase stake from Valiant Partners as well. So, Shriram Finance holds about 83.8% in Shriram Housing Finance, while Valiant holds about 14.8% stake in the company. The financials for Shriram Housing Finance as of FY24, the AUM is about 13,760 crores. Gross NPA ratio is around 1%, with net NPA ratio at 0.8%. They are very strongly capitalized at about 24.97% capital adequacy ratio. We have brokerages who have written on this. So IIFL Securities has written on Shriram Finance. They have a buy recommendation, a target price of 2,850 per share. They say that less than 0.5% valuation benefit from the stake sale in the HFC subsidiary to Shriram Finance is taking place. The deal values Shriram Housing Finance at 2.1 times FY25 price to book value, which is lower than peers. The transaction will accrue profits of about rupees 2,350 crores, which will result in 110 basis point accretion to the tier 1 capital of Shriram Finance. So transaction should enable Shriram Finance to relocate its capital to high ROA business like vehicle financing as well as consumer financing. Back to you.
Okay, thank you very much for that. Ethos is up 7.5%. This is a distributor of luxury watches. And the numbers came out yesterday, strong numbers. But I think post-market hours, there was, the company uploaded the presentation on the exchanges. So Mangalam joins in to tell us more. Mangalam.
Well, nothing quite sells like luxury, right? You have the numbers of the company Ethos, which were uploaded at around 310, and thereafter around 340, 345, we had the presentation which was uploaded. So just by the numbers, weren't particularly bad. In fact, 22% revenue growth is what they've reported, and that's directly, led to a big operating leverage jump as well, because the EBITDA margins have actually improved by 200 basis points, which implies a growth of 40% in the EBITDA, close to around 36 crores. This compares to the number of 25 crores, and the net profit has increased by 58%, which is obviously a jump from 132 crores all the way up to 210 crores. The presentation told you a lot of the strength in the internals. The first one is that the average selling price per watch has actually more than doubled in the last 4 years. So FY25, the average selling price per watch at Ethos was close to around 84,000 rupees. That's gone all the way up to 1.9 lakh rupees. And that's not all. The share of luxury watches, which has also been a strategic move by the company to, take off all the low-priced watches from their mix, have increased from 48% all the way up to 68%. And the other growth verticals that they're seeding, which is second-hand watches, that have grown around 27% in FY24. The company's added 5 brands under exclusive arrangements, and that really gives them better margins. And they've opened 10 stores in FY24, one already in FY25. So going forward, what are the triggers that the company's laid out and the street believes would be one for Ethos? The first one, of course, would be expanding their own physical store network. Secondly, increasing the arrangement that they have with a lot of these exclusive brands, getting more of them, so that makes their store thickens the moat of the store. And then you have growth in their pre-owned luxury watches business as well, which is a fast-growing vertical for them. And finally, expanding into other luxury verticals. Now that you have a set of customers which are, a certain type when it comes to their purchase decisions, you can also obviously upsell or cross-sell to them luxury watches, luxury jewelry, and luxury luggage that they've entered into as well.
Okay, Ethos flying high and really cruising along the luxury path. Got that. Well, we do have to, discuss Zomato, of course, with Mangalam as well. But before we get to that, I was just thinking, the market's reaction can be absolutely baffling in certain cases. We had 2 earnings that came out yesterday. One was Zomato, stellar numbers. The other was BEML, again stellar numbers. Both the stocks have rallied close to 200% in the last 1 year. To be very precise, we'll pull up the charts for you. BEML has rallied about 170-80% in the last 12 months. Yeah, there we go. These are, of course, today's. We should flip that over and we'll give you a sort of a 1 year perspective as well. So basically, now we have the numbers. 190% on BEML and 200% on Zomato. My point is that both stocks have had a dream run coming into Q4 numbers. Both companies deliver really well. BEML gets a 15% up move, salute, plus 5% today. And Zomato has been in the red ever since. Anyway, so that's the market for you. But Mangalam, let me come back to figure out if there's any clue to this mystery as to why is the market disenchanted with what looked like a superb performance from Zomato.
Well, so the performance fundamentally was pretty superb, like you said, and it's led by the quick commerce business, which now the street is beginning to value more than their food delivery business itself. A couple of weeks ago, we had, Goldman Sachs come out with their report where they valued this business at around $13 billion, which is an over 22 times jump from the valuation at which Zomato had first bought Blinkit itself. Now, they've spoken about Blinkit a lot more at length in their press release and the question and answer, report that the company releases. They're aiming to double the Blinkit, store footprint from 526 stores to about 1,000 stores, and they're adding close to 100 stores in the first quarter itself. While Blinkit has reported an adjusted EBITDA break-even, they believe that going forward for the next few quarters, the margins would be near zero, and that's largely because of this expansion that they have undertaken. But at a steady state, Blinkit could actually be around 4 to 5% sort of margin business itself for them. Nomura has a buy rating on the stock. They've upped their target price to around 225. They expect this business to grow around 65 to 99% over the next couple of years. The business I'm talking about is quick commerce with contribution margins of sub 5%. Citi has also increased their target price to 235. We have Bernstein saying 230 and CLSA saying 248. That's the increased target price. Jefferies, however, they have a buy rating on the stock largely because of the fundamentals of the business and the quality of the management. But they've been a little cautious. They say that the easy money in Zomato, all the way from 40 to around 200 rupees, has been made, and return expectations from this stock, irrespective of the growth expectations, should be modest over the next couple of months. So that's something that explains the kind of move here. And the other couple of factors that may lead to increased expenses going forward are, the employee ESOP plans that the company has made, where they'll dilute about 2% of their equity. That may result in slightly higher employee expenses over the next couple of quarters, as well as they adjust for those ESOPs. So those would be a couple of quibbling points, but no real fundamental issue with Zomato here. In fact, more so for Blinkit, where the growth is a lot higher.
Okay, thank you very much for that. And what about Colgate? Pull up a 6-month chart of Colgate and you would see a one-way rise in the stock price. The stock price 6 months back was closer to 2,100 and now it's inching towards 2,900. Reporting numbers today, Mangalam, what's the street expecting?
Street is expecting good numbers coming in for Colgate, and that's largely because, of a lot of things that the management has done. Ever since Prabha Narasimhan has taken over in Colgate, they've worked towards growing the category, growing the increase of usage, and also worked towards improving their value offerings in the core product, which is the CDC brand, which is the red Colgate that everyone knows of. This time around, good results expected because we have a peek into the oral category with the kind of numbers that have come in from Dabur as well, where they've said there has been a bit of a resumption in the natural segment. Revenue growth, what we're expecting for Colgate this time around is 10%. With, the operating leverage playing out, margins are likely to expand, so EBITDA growth of 14% and the net profit growth of 15.5%. The numbers you're looking at, 1,486 crore on the top line, 515 crores on the EBITDA and 365 crores on the bottom line as well. What is this number likely to comprise of? 3 to 4% volume growth and near 4 to 5% price mix growth, where premium products are doing well. Rural contributes around 40% to Colgate's revenue. So any sort of upshoots that we're talking about in the rural economy would be visible in Colgate numbers as well. And the commentary to that extent would be extremely crucial. We have seen, the company increase their ad spends. So looking at performance in their natural segment and some of their new launches will be extremely crucial to watch out for. And also they very recently launched a new range of Palmolive body washes as well. So they're going beyond Colgate. Expect Palmolive to grow at 2x the company's overall growth rate. So this is something that we'll be watching out for too.
Okay, all right, got that. Mangalam, thank you very much. We've kept you really busy this morning, but appreciate all the inputs on all the companies and stocks that we've discussed. Well, we have to take a break on that note. We'll come back on the other side and should focus to the commodities arena, figure out what's buzzing there. Manisha is putting the spotlight on oil prices. We'll get you more details in a bit. Welcome back. You're with us on Trading Hour. As promised, let's put the spotlight on the commodity space now and ask Manisha what's happening in the crude markets. Manisha, good morning.
Morning. Thank you for that, Survi. Well, there are 4 things that are happening in crude prices, keeping the prices where they are right now at around $83 a barrel. Well, one is that you are looking at strong demand coming in from China. The economic data that has come in from China has been on the positive side. And then China also is saying that they are looking to raise 1 trillion yuan through issuance of bonds, and that would mean more support coming in for the market and demand as well. So China is your first factor. Second is the supply disruption concerns that the street is looking at from the Canadian wildfires that we are seeing there. Well, remember, last year was the worst year for Canada in sense of wildfires, and the markets did lose 300,000 barrels per day of crude there. Now, Canada does 3.3 million barrels per day of crude, and there are concerns because some of these wildfires are very close to key oil facilities there. And are we looking at that kind of an output cut yet again is what is bothering the markets. That's your number 2. Third is there is an important data and a survey that has come in from the US Motorist Association, which says that the long weekend of May 25th to 27th could be looking at the highest driving activity since 2000. I mean, if these numbers actually do come out, then you are looking at a very strong on-ground physical demand coming in from US as well. And the fourth point is the OPEC and allies, which now say that OPEC will stop pushing or publishing a monthly report only as per, say, OPEC. Now the reports would come in as OPEC and allies. allies. The first OPEC Plus meeting is on first week of June, but ahead of that, the monthly report that comes in this week is going to be quite interesting on how and what numbers does it take in, and all of those factors is what the street looking at, and you can see support coming in from them.
Thank you very much for that. Let's also listen in to what the head of oil research at Goldman Sachs had to say about the current oil demand and the rising prices.
On the demand side, I would characterize oil demand globally as still pretty solid, especially in India and the US. But at the margin, we're seeing some misses in China. And I do think that has to do with the fact that relatively high oil prices relative to natural gas prices are incentivizing, for instance, Chinese trucks to switch from oil to gas. On the supply side, I think the story of last year, where supply growth outside of core OPEC is strong, continues to be the case. About a month ago, we highlighted that $85 per barrel for TI and $90 for Brent is likely going to be a ceiling because there's a lot of spare capacity. More than 6% of the global oil market is currently in spare capacity.
Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in with his top trading bets. Welcome back. HAL and Cochin Shipyard are both higher in trade. Upasana joins in with the details. Upasana.
Well, UBS has increased the target price for HAL from 3,600 to 5,200, and it has forecasted a 3x increase in HAL's order book and 25% revenue growth in a manufacturing top line from FY23 to FY27. Well, the brokerage says that this would be led mainly by a pickup in large military orders due to depleted fleet, a robust supply chain and ready capacity of the company. It also expects order wins of 5.3 lakh crores over FY24 to FY28, implying a quadrupling of order book by FY28. It has also raised its FY25 to FY27 EPS forecast by almost 4 to 11%, and it says that this increase in the target price, which is almost 44%, is mainly led by earnings upgrade, increased PE, target PE from 32 times to 40 times, which is nearly 25% premium to BEL's valuation. It believes this is justified by HAL's better order book scale-up, low competition and great optionality in the export market. Now, moving forward to Cochin Shipyard, the company secured order in the range of 500 to 1,000 crores from a European client for the construction of hybrid service operation vessel, and this project is expected to be completed by the end of 2026.
Okay, got that, Upasana. Thank you very much for that. So that's one stock in focus. Let's move on. Aarti Pharma has been surging in trade. In fact, it's probably one of the best result reactions this morning and this after reporting numbers that have gone down very well with the street at the end of the fourth quarter. Ekta is here. Ekta, what has worked for the company?
Well, yes, it's a good operational performance which has come through for Aarti Pharma this time. So the revenue is up around 4% on a year-on-year basis. What has stood out is the operational performance. EBITDA around 117 crores, which translates into a margin of 23% versus 16% year-on-year, and a profit of 65 crores versus 43 crores year-on-year. Q-on-Q as well, the EBITDA has looked good for the company. So EBITDA is at around 117 crores versus 95.7 crores Q-on-Q. Margins improving to 23% versus 21%. So overall good performance. Operational beat is what stands out for the company this time. Okay,
so those are some of the stocks that are in the news now. Let's go forward and discuss some of the market trends and trading bets with Mitesh Thakkar, who's joining in. Mitesh, thanks very much for being with us. Let's start first with your overall thoughts. The index is absolutely caught in a range. Are you looking at any trades there at all?
So I think, good afternoon. I think, what can happen is that the index is kind of hovering around this 22,200 mark. A break about 22,220, I think, could invite some long positions. But till then, I'm in a wait and watch mode. So we've had a high of around 22,190 in the morning, and then we kind of tapered off. We have made a comeback again. So let's see how it goes. But 22,200, 210 is the level which I'm watching on the upside.
Okay, some updates coming in on Hindustan Zinc. Its bids are qualified for the gold blocks in the Bukaria, Jagpura and Kankriya Garabol clocks. So, good news. its technical bid appears to have been qualified for 2 gold mining blocks in the state of Rajasthan. Mitesh, morning, and thank you for joining in. Just wanted to get your thoughts in on HAL, BEML, Cochin Shipyard. The rally continues unabated in these stocks. Just in the near term, what are the charts telling you?
See, I think HAL, made a fresh high, but what is interesting is Cochin Shipyard. After a pullback, it's given a reversal today. So from a trading point of view, the risk-reward equation is slightly favorable for Cochin Shipyard. I would recommend a buy here with a stop below 1250 and a target of around 1400.
Okay, got that. And Mitesh, since we have you with us, I mean, some of the very strong reactions from yesterday, Rima was talking about BEML, even ABB. I mean, we had big moves on these stocks. Siemens is reporting numbers today. Any other interest in any of these capital goods or industrial stocks? Anything you like?
Like all of them, but with the BML numbers and the kind of gap up it's seen and the run up before that gap up as well, they're not offering you a good entry point because then the stop loss is not slightly, it's actually very deep. So if somebody's holding on, I think just hold on. For ABB, I think yesterday's gap up becomes your stop loss, which is about 7,200. But you can't take a fresh entry with that 7,200 as the stop loss. So just hold on till, we kind of try and figure out higher levels, when the stop loss can be trailed to. And for the time being, 7,200 for ABB. And for Siemens, I think the stop loss corresponding level is around 6,180. And these are the revised stop loss on your long positions. But a fresh entry with these stop losses is not what I would recommend.
Okay. Thank you very much for joining in. Moving on to BEML, that's surging in trade after reporting a good set of Q4 numbers. Margins have expanded. The profits have jumped up 65%. The order book, though, has missed the FY24 guidance of 14,000 crore. Earlier today, we chatted with Shantanu Roy, Chairman Managing Director of BEML. Listen into some of the key excerpts from that conversation.
The guidance that I have in my mind is a further growth of around 100 basis points over this 12% EBITDA annually. Top line growth, I will maintain it at around 18 to 20% CAGR for 24-25 as well as the coming years as well. We just barely managed the top line growth of around 4% in the last year, but there were certain reasons for that. And one of the major reasons was the challenge on the supply chain, challenge on the material, which was beyond our control because of various geopolitical happenings. We missed the guidance of 14,000 crore. So I don't know whether it's because of the election year or not, but yes, there was some more tenders which were deferred, especially in the metro and the rail sector, where around 3,000 crores of orders were deferred, which will now happen. The guidance that I have just given, it also has TCMS, but it will not be the indigenous TCMS. The indigenous TCMS, when it comes into play, because it is, once we develop, it has to undergo validation, it has to undergo extensive trials. So the entire thing may take, that's why I said 12 months to 18 months. Once it is done, then, of course, every year we see a growth in the metro. So if we annualize, the annual metro rolling stock guidance is around, I'll put it at around 2,000 to 2,500 crores. That is an average. And that is the kind of opportunity size that we can see in the future.
Okay, so that was some of the management commentary that we picked up during the course of the morning. We will take a quick break. On the other side, we'll get some fundamental conversations going. Deepak Jasani of HDFC Securities will be joining in. Welcome back. Well, there's green back on the screen now. The Nifty is managing about a 0.25% move up. The mid-cap index is a little better with about 0.5%, just under 0.5% up move. You can see how choppy and rugged that graph is. The level of volatility in tight ranges, that's been the hallmark of trade so far this Tuesday morning. Let's take the conversation now to Deepak Jasani, who's joining in, head of retail research at HDFC Securities. Deepak, good to have you on. We want to start by discussing how the market has responded to some of the earnings that came in from the capital goods arena. And I'm specifically, of course, talking about ABB. Very, very sharp reaction there on the upside. And even BEML. BEML also striking a confident note for the current year. What is your stance on some of these companies, and what would your expectation be given the very sharp run-up in stock prices already?
Yeah, good morning, and thanks for having me. Capital goods sector or engineering sector has been one of our favorites for the last few quarters, mainly because of good amount of visibility that we have in terms of execution of, in terms of order bookings, in terms of margins, which are quite protected despite commodity prices fluctuating. So now, whether it is the power sector, which has been seeing an uptick in ordering, which has benefited stocks like ABB, or BEML has been benefited by defense-related orders. So there, I think the revenue visibility, the consistency in the growth top line, and the maintaining the margins or improving the margins is what is attracting people. So despite the fact that the core valuations look a bit stretched, I think people want to flock to areas or sectors where they are quite confident of deliverance of financial performance quarter after quarter.
Deepak, if someone has a 3 to 5 year time horizon, is Zomato attractive at current levels of 190 rupees, 200 rupees? Or because there is a risk that competition is, a listed competitor is going to be on the anvil very soon, Swiggy, then maybe the valuations could come under pressure. How would you approach something like Zomato, even if you have a long-term time horizon?
So we don't have a coverage on that stock, and I would not like to comment in depth on that stock. But having said that, I think the space has done quite well so far, and there is a lot of potential of growth in that space. Plus, this company has that Blinkit, whose valuations is supposedly to be higher than the core business. So, in that sense, all the key things are in place. Having said that, I think one will have to sort of time your entry appropriately to sort of avoid the risk of slowdown from competition or from regulatory issues as and when they sort of crop up.
By the way, I'm just sort of looking at railway stocks. All of them have spiked up in the last half an hour. I mean, it's been quite a move. Let's pull them up. RailTel is up 7.5% right now. IRFC is up 6.5%. Ircon 6%, RVNL 6%. So the railway rally,
IREDA, that's up 5%.
IREDA is up as well. So the whole railway rally is, has begun all over again. The rail run is chugging along. Maybe one can say very interesting. This is after a while, after a bit of a gap, that we're seeing such a move across the board in railway stocks. That's an interesting trend. Deepak, what's your view on these companies? I mean, railway PSUs. They've had a good run. And how would you sort of look at them now? Are any of them still under your coverage portfolio? What's the advice?
So we have had buys on some railway stocks in the past, and the targets have been met. So as of now, we don't have a buy on any of them. Now, what has happened is the results, the Q4 results of rail stocks have been a sort of mixed bag so far. And I think being PSUs, election-related expectations will drive them up and down every now and then. So in case one feels that the current government is going to get re-elected with a good majority, then probably the whole PSU basket, including rail, defense and banks, will see a re-rating. Maybe we'll see sectoral rotation or thematic rotation day after day. So today it's a turn of railways, maybe tomorrow it will be defense, and maybe day after it will be something else. So that is how we will view the sector or the theme currently as.
By the way, the other pocket which is seeing buying is the entire shipbuilding stock. So Cochin Shipyard has won a large order. So that's that's pushing the stock up. But other than that, you've got a Garden Reach Shipbuilders that's up more than 6%. Mazgaon Dock is up close to about 6.5%. GE Shipping is up 5%. SCI, even smaller companies like Shreyas Shipping are showing you gains. So that's the other. So I think just PSUs are back, right?
They never went anywhere, I think.
They never went anywhere, but defense is up, shipping is up, railways are up. So that's, clearly the pocket of interest. Deepak, any thoughts on Titan now? It was a favorite. It was a portfolio stock for most investors. But now what the management had to say about competition eroding margins, at least in the near to medium term, is that something which is enough for investors to just book profits on your investment?
Yeah, our institutional wing has a sell call on Titan. So in that sense, what you say makes sense in the sense that with the competition growing, with gold prices continuing to rise, the attractiveness of Titan at these kind of valuations is quite low. So maybe once it has some other trigger, or once gold prices come down and we see resurgence of buying in jewelry, then we can have a rethink on that. But till that time, I think we have sell.
By the way, that's really interesting news on your screens. It's exclusive that Mankind is on the prowl looking to buy, company for about 2 billion. That's a large valuation for Bharat Serum. That seems to be the target entity. Mankind is looking to buy, and it'll be buying from Advent, the PE promoter. That's the news that we're picking up, and we'll try and get you more with our sources in just a bit on this. Mankind is also reporting numbers today, by the way. Stocks up almost 4%, so we should have more clarity once that investor call happens. Deepak, any interest? Mankind or pharma? I mean, Mankind's been a bit of a unique story, right? Largely all domestic, and it has done fairly well since the listing.
Right. The company has grown quite well since the inception, and since listing also, it has seen a rise in the valuation. But at this point, we don't have a coverage on that stock. So nothing more than that.
In the auto pack, which one would be your preferred stock? The numbers are looking good. At least the two-wheelers, there is a recovery in rural demand. The Tata Motors has taken a bit of a hit. How would you approach the auto space now, the frontline stocks?
So within the auto space, our institutional wing has a buy on Mahindra and Mahindra. So that is the stock where we are bullish, having sort of valuations or SOTP kind of structure from various businesses, including the tractors and their personal. The PVs are also doing quite well lately, the SUVs especially. So that is the current pick.
Okay. All right, Deepak, we will leave it on that note for today. Thank you very much for joining in and taking our questions. On that note, let's take a quick break. On the other side, we'll come back with an interesting discussion. Luxury sales of residential homes have overtaken sales of affordable homes in the first quarter of this calendar year. Now, that's a headline that perhaps will really catch your attention. More on this, we will discuss all the trends with Anuj Puri, chairman of Anarok Property Consultants.
Welcome back. Let's now throw the spotlight on the real estate sector. Now, property consultant Anarok, in a recent note, has said the share of luxury homes, which means homes priced above 1.5 crore in the last 5 years, has shot up. So 5 years back, in 2019, the share of luxury homes was about 7%, and now it stands at 21%. So that's a 3x jump, while the sales of affordable housing is down to 20% versus 37%, again, in the same period of 5 years. To talk about the trends that we are seeing, we're now joined by Anuj Puri, chairman of Anarok Property Consultant. Thank you very much, Anuj, for joining in. First, actually take us through what your study throws up. What are the key takeaways?
So first of all, very good morning to you and your viewers. It is a very interesting dynamics the way the residential market is performing today. I'll just take you before COVID, 2019-20 financial year. the overall sales in value terms for India amongst the top 7 cities was 1,65,000 crores. And FY24, 5 years hence, that sales is 5,25,000 crores. So 1,65,000 crores just before COVID, going to 5,25,000 crores. So the overall market has really zoomed up. In that, the luxury has accelerated faster than the affordable housing. So I do want to say the affordable housing has grown because the overall market has grown, nearly 3.5 times. So both have grown, affordable housing and luxury, but luxury has grown faster than the affordable housing. Overall, we are seeing that it was a 15-year record year for sales. Clearly, the sales have been much more than the launches, and the overall inventory has reduced to nearly a 7-year low, particularly in NCR, where we've seen the luxury sales really balloon.
Okay, I'll just stay on for a second. We're just getting visuals of the Prime Minister in Varanasi. I think he would be going in to file his nomination papers over there. And those are the visuals that are coming in today. Of course, yesterday was the roadshow at Varanasi. And today he is filing his nominations from his constituency.
Okay, soon after this on Friday, beware for traffic because Prime Minister Modi will be holding a rally at Shivaji Park. It just came in the paper. So ahead of, the Phase 5 election starting, on Monday, 20th of May. So Prime Minister Modi will be in Bombay.
High decibel. It's as loud as it gets.
And that's
really
en route you going
season.
back home, Surbhi.
But it's okay. This is what the dance, the dance of democracy as it's called, the festival of democracy as it's called. It's what it's all about. But yeah, for me, obviously, it is en route home. So need to take those diversions into account as well. But, that's the electoral season playing out. But let's now come back to that conversation with Anuj Puri that we were having on the rise of luxury housing in the country. Anuj, I was looking at the data that your sort of colleagues put together. The fact is that this is most pronounced perhaps in Delhi NCR, right? Because that is where the share of luxury has skyrocketed in the last 5 years. It's gone up to some 39% from just 4% 5 years ago. Whereas if you look at other geographies, look at Kolkata, even look at, Mumbai, MMR, your data is saying that this is not a market where there's so much luxury sale, it's a lot of mid-income housing. How do you sort of look at this trend in Delhi NCR where it's just these large ticket houses that are flying?
So it is true, Surbhi, that NCR has pleasantly surprised us. And, if you look at the sales that DLF has recorded, Signature Global, which was largely an affordable housing developer, since listing has moved into premium and luxury. Again, Surbhi, Ashiana listed, they were largely mid-level. If you look at the product, they're moving into premium and luxury. M3M, similarly moving in that direction because the demand is really coming in from the users wanting bigger, better, more expensive. Many people are consolidating their positions in the stock market, taking out the money and using this for buying their residential homes. We've also seen, the price appreciation happening in the luxury far more than on the affordable side. So nearly 20% over the last 2.5 years, the price rise that has happened on luxury. But more importantly, Surbhi, what has happened is since COVID, people are wanting bigger apartments. So as a result of which the price is increasing as a total, ticket price. And it's also escaping the definition of affordable housing. The affordable housing definition, which the government had set up in 2017, has not been modified. It's been 7 years. That definition of 30 square meters in tier 1 and 60 square meters in tier 2 still continues. The same is the demand from the end user has gone up, post-COVID, not wanting that 1.5 bedroom, but they're wanting sort of bigger, 2 bedroom, 3 bedroom, 4 bedroom.
Sure.
So that is where I think both those things are happening is, one, stock market consolidation and people taking out the money and buying really luxury. And then people move away from affordable because they're wanting bigger and hence not falling in the definition of affordable housing.
Of affordable housing, yeah. I mean, very valid points. You said 20% appreciation in 2 years. That's luxury, appreciation only in NCR or all over the country?
So this is largely all over the country.
All over the country, got it. So Anuj, my point on luxury is simply this. How convinced are you that this is, as you're saying, even genuine end user demand, people looking for bigger homes? And is there an element of speculation building up? The reason I'm asking is that, is it really feasible that every single project that's launched, I mean, in NCR, it's a norm, right? Sold in 3 days, sold in, gone in 60 seconds and the likes of it. So is that an element of marketing / speculation investor demand that's creeping in? Or is it, plain genuine demand? I'm asking to gauge the health of the rally, the real estate rally, as we see it today.
A very important point, Surabhi. So I'll say two things. One is it is not with all the developers what you're seeing the sellout that is happening. It is only with good quality developers. The consolidation, the maturity that has come into the market. Any developer wanting to launch luxury will fail in NCR, will fail across India. It is largely the listed developers or even unlisted, very leading developers. So the buyer has become very discerning. As a result of which, I will not say it's a generic statement that anybody who launches luxury will be able to sell it. It's really quality developers who are going to be able to sell it. I'll give you one more trick, Surabhi, on this is that, when we come out with the news that, we sold it in 8 hours, 1 day, 15 minutes. Actually, it is not that we sold it in 15 minutes or 8 hours. There's been a 1 month work that was done before that. So you had warmed up the market, you had brought in the potential investors, you actually just banked the checks that time. So I'm telling you a secret in that is, so when we say it sold out in 8 hours, there was nearly 1.5, 2 months of work done before that. All you did that day was bank the checks and hence you recorded the sale that day. Otherwise,
and
it's
you
not...
still have... And even on that day, Anuj, to bank the check, you just have to put a small upfront amount, right? There is a possibility that some of them back out.
Absolutely. And they do back out. But, most of the developers will make sure that, they are able to cover whatever the cancellation that happens. Usually we take between 10 to 12% as cancellations that will happen, after the first day. And those cancellations, then they'll fill it up over the next 30, 40 days.
Okay. At least with that clarification, Rima, I'm feeling slightly better because when you hear of sold in 1 day, sold in 8 hours, you wonder, oh God, I have zero money to buy any of this. But okay, there is a lot of back-end work that's going behind the scenes as well, and there are other factors at play as well. Anuj, just to come to the other point, I mean, we are in election season. Once elections are done and, we're dealing with a new government, any more sort of SOPs, triggers, regulatory changes that you're expecting to also address the other sides of the market, the mid-income and the so-called affordable, where the definition is an issue, as you explained?
I do feel is that the affordable definition will really need to be looked at. As I said, it's been nearly 7 years and it hasn't been looked at. And that's why, you're seeing the data getting distorted, where the demand's really moved in for a little bit bigger homes. Post-COVID, yet because of the definition of affordable, we can't take that into the affordable housing and hence, it's getting out of that and showing a skew more towards mid-level or premium. So that's one thing that we are hoping. And second is, hopefully some SOPs for the developers, because if you look at it across the board, many of these developers who used to do affordable housing are getting away from affordable housing, saying is, it is not as, accretive on the margins as perhaps mid-premium or luxury is. So I do feel is that at some stage, one will really need to look at it. Some of the old SOPs that were being given to the developers where the sunset had happened, perhaps will need to be brought in again or at least relooked so that they get excited, the developers get excited to be able to, get back onto the affordable housing. But, having said that, on the PMAY, the government is doing a phenomenal job on the affordable housing. And, they're not only talking, but if you look at the data that is coming out, they've actually been able to deliver, a lot of these affordable housing and hence fulfilling the shortfall that is coming in from the private sector on affordable housing.
Thank you, Anuj. This has been a great conversation. Thank you very much for joining in. By the way, lots of buying is coming through in Adani Group stocks yet again. So Adani Enterprises, Adani Ports have moved to the high point of the day. Adani Enterprises now has a 5.5% rally. Look at the way the stock has moved up just in the last 30 minutes. Adani Ports too is inching towards a 2.5% gain. Get into a break. We'll come back with more. Stay tuned.
Welcome back. As promised, let's get you more details on that exclusive news story that just flashed a couple of minutes ago. Sources telling us that Mankind Pharma is on the prowl and it is looking to acquire Bharat Serum and vaccines. Rachna is here with more details. Rachna, tell us what you're learning.
Well, yes, sources with direct knowledge of the matter have told CNBC-TV18 that Mankind Pharma is considering Advent International's stake that is in Bharat Serum vaccine to be purchased. Now, Advent International owns 100% in Bharat Serum and vaccines and is looking to sell at a valuation of about $2 billion after 5 years of acquiring it. It was in November 2019 that Advent International had first acquired a controlling stake in the company of about 74%, and then eventually they raised the stake by giving exits to the promoter family and raising the stake to up to 100% in 2020. Now, along with Mankind Pharma, it's also Swedish private equity player EQT Partners that is looking to bid for this same. Advent International is seeking the sale of about $2 billion. They had purchased the 74% stake in the company in 2019 for about $500 million and given the promoter family an eventual exit for an undisclosed amount. Now, this sale comes at an interesting time as the healthcare sector is picking pace. Now, Bharat Serum and Vaccine is especially focused on women's healthcare, assisted reproductive medicine and emergency medicine.
Thank you very much for that, Rachna. That's an important story. And with that, we're going to wrap on Trading Hour from the entire team. Thank you for watching.